If you've been watching your investments lately or been paying attention to the news, you've probably noticed that investments have had a lot of big up and downs lately. They've had a lot of volatility and a lot of big swings over the courses of days or weeks. This is actually kind of natural for investing. It doesn't feel very natural and it's very nerve-wracking when it actually happens, but it's actually a normal part of the market cycle. Market cycles inside the stock market and bond market are driven by a lot of things. Some of those things are economic, there's interest rate changes, there's geopolitical events, and all of these things many times have short-term impacts on prices. Markets may move up or down based on some short-term news, but many times, even when they do drop quite a bit, history tells us that they tend to recover, and they tend to recover very quickly. As of 2025, early 2025, where we're sitting right now, the market has experienced quite a bit of volatility since November of 2024. We've had some days and weeks where the market's been up 4, 5, 6%, followed by the next week where it gives all of those gains right back, and it feels like we've been on this extreme roller coaster. However, over the last 3 months, the market really hasn't done that much. It's just basically been a roller coaster to nowhere. And much of that volatility has been driven by a couple specific things that we've experienced over the last 4 to 5 months. One of those things is geopolitical risk. Uncertainty across the geopolitical environment, things like the Middle East, things like Russia and Ukraine, tend to increase uncertainty in the market, which increases volatility in stock markets and bond markets. Additionally, there's a lot of uncertainty right now about policy. There's a lot of talk right now about tariffs, and there's been a lot of changes about this talk about tariffs, even in the last couple weeks. What happens with tariff policy, whether it's unilaterally created across all of our trading partners, whether it's focused on things like steel, or whether it's specifically targeted at countries, all impact U.S. investments as well as international investments. And this is driving some of the volatility as well. But one of the interesting things that also underlies all of this uncertainty is the fact that many economic indicators still remain relatively strong. And so things like corporate profits, things like inflation, all of those things actually show that the economy is still growing. And so we have some of these things that are creating uncertainty, but we still have a pretty solid base underneath. And so we many times get questions from clients about, how do I make sure that I stay on track? How do I make sure that this volatility doesn't negatively impact my plan? And there's 3 key things that I want to talk about. First is making sure that you keep a long-term view. It's really easy to get caught up in the short-term fluctuations. It's really easy to see your statements and watch some of the dollar values go down and get really, really nervous. But when we're investing for long-term returns. And when you can keep that long-term perspective, it really helps ride out some of the volatility and changes your perspective, allows you to take advantage of opportunities as opposed to having a fear-driven mindset. Secondly, we want to make sure that we have diversification in your portfolio. And diversification is across many different levels. First, it's a stock-by-stock diversification. We obviously don't want to hold just 2 or 3 stocks inside a portfolio. But additionally, and even greater than that, we want to make sure that we have geographical diversification. We want to make sure that we're not just overly invested in the US or international, but we have a good mix across the board. And we want to make sure that industries also are diversified inside our portfolios. When we have diversification, it helps smooth out the returns. We really don't give up any expected return, but it helps make that ride a little bit more smooth. And lastly, making sure that your portfolio is personalized to yourself is a really important part. Making sure that you just don't have some model portfolio or something that's roughly attached to your age, but instead your portfolio is specifically designed for your goals when you're going to need money out of the portfolio and the plan that you have in place. We've found that when clients have portfolios that are tailored to their specific plans and their specific goals, it helps them view volatility differently. It helps them view volatility as a place for opportunity as opposed to a time to be scared. So again, make sure that you keep a long-term view, make sure that your portfolio is adequately diversified, and then make sure that your portfolio is personalized. Underlying all of this is that many times during volatility, this is when a financial planner can be the most impactful in your investment strategy. A financial planner should make sure that you have that long-term view, should make sure that you're diversified, and most importantly, should make sure that your portfolio is personalized to you. So if you're working with a financial planner who maybe doesn't do those, or you haven't worked with a financial planner at all, please reach out to me or my team. We'd love to talk to you about how we can navigate this difficult environment and make sure that you stay invested correctly for the long term.